Hey,
Yo,
how you guys doing, everybody? Though, good. Can you hear me, Mike?
I got you. Sorry, I froze there for a second.
Oh my God, though. This is my favorite person to speak to, right? Especially on the panel, especially on the webinar, though. Mike, thank you for joining.
Happy to be here, Igor. As always, good to be back with you.
Yeah, thank you very much. And for everybody who is joining us as well for a live stream, today, Mike, we're doing exceptional things. We are on Facebook, we are on Instagram, and we are on not the national television yet, but on LinkedIn. Yes. Okay. Happy to be here, you guys. Welcome, welcome, everybody. And just a couple of things, right? Why we actually connecting today? What's the purpose for that? And the good thing to say is the private credit fund. When you tell people private credit fund, so like when you say private, it's confusing. When you say credit, it's more confusing. When you say fund, they already got you already lost them. It's like you lost the attention of the people though. Yeah, so the private credit fund, super overwhelming, I think, as a general thing, as an idea. But if you look deeper, if you start to talk to professionals, it's a very, very simple thing to understand. And that's the reason we're here tonight,
Well,
right?
very excited. I'm very excited to dive into some assets here.
Absolutely. So we got Mike Sullivant from Aspen Funds. Mike, thank you for joining again one more time. Mike is responsible for capital markets at Aspen Funds, and we've been working together for a couple of years now. Nothing but great experience. And we want to dive into the private credit fund and why actually we want to do, not we want to do, why we actually doing this, and then what's the reason for that doing this right now, why it's not 5 years ago, right? Why it's not like 20 years forward as well. So why are we doing this right now? And first slide, I want to bring it up. And in the general market, Mike, and I want to ask you a couple of questions as well. In the general market right now, we just got the election day, right? Everybody knows who's the president now. And I think that pushed the market a little bit forward was the real estate investments and the financing and the capital markets. Can you give us a little bit of your personal opinion? What's going on right now? Because a lot of people have been waiting on the sidelines. They were not, exactly sure what to do. And now I think the sentiment is shifting to the different side, right? Can you give us a little bit of your thoughts on that?
Yeah, for sure. Well, I think our sentiments remain, similar to where we've been this past year, 2024. Obviously, going into 2025, new administration can, potentially shake some things loose. Specifically for this, this fund, we're serving assets that are, we're issuing checks in the $1 to $5 million range per asset. And so what we find is that regardless of kind of broadly what's happening in the market, is this kind of subset of assets is very, very underserved. So we see still strong runway for us to continue to deploy capital into underlying assets, multifamily, industrial, in kind of these small to mid-size type of assets on a consistent basis. So, with Trump coming in, what we might see is, credit loosening a little bit with banks. That's been one of the big dislocations is tightening of credit, and uh, but ultimately, interest rates and inflation, what we see is likely to be a bit stickier than I think people would have hoped, and what uh, a lot of operators like you and I would love to see interest rates come down. But I think the general sentiment from in our office is that we are we're going to see inflation sticking around a little bit more. We're probably not going to see rates cutting the way that we had hoped in 2025. Likely seeing some stabilization of rates, probably not seeing significant increases like we saw here a couple of years ago. So I think long term, good news for operators as far as kind of short term. We don't see much significant change through 2025.
Yeah. Thank you, Mike. Thank you. I think that's helpful for everybody, right? And we're going to go to this slide, which is again, we want to talk about why private credit fund, and there's a couple of things we want to talk about. We'll put them on the slide here. So there's a high current yield, right? If you're talking about the markets and you want to put your money at work in different assets, like you can probably be part of, right, on the market right now, I think there's a, like you said, dislocation of the capital, meaning there's a, higher interest rate environment, which is pushing current deals and current operators to do something with their existing loans, meaning they go out on an open market and they try to refi, right? And then when they go to the market, then they start to face the reality of saying, now our debt payment will be double because of the interest rate. And that's a tough pill to swallow. Like, it's a very tough pill to swallow that, right? And you got to go on the market and say, listen, we need to get this cushion. Can you give us a check between 1 to 5 million, which is necessary for us to get refinancing? That's one of the things, right? Why this fund existing. And like Mike said, we're going to talk about that later as well. Not a lot of competition in that space, right? Because you talk to the larger companies, bigger, stronger, longer established, and so they don't want to touch anything maybe $15 million below, right? They say we start at 15 million. So because we have a feed, a really big, team, right? There's a lot of people working for those companies. And yeah, the only way for them to survive to get into the larger deals, I'm talking about to finance larger deals. Why? Because they can cut the check for larger, right, fees and stuff. So, and that's why 1 to 5 million is like a sweet spot on the market, especially right now. Because if you're talking about 100 units, a multifamily building, which is purchased, let's say 2021, 2022, right? Say, and they want to refi right now because it's been due for their loan. So you talking about 1 to 5 million help from the private credit funds like ours to get that refinancing going. Is that right, Mike?
Yeah, I mean, those are some scenarios. A lot of the assets are also ones that are transacting. Properties being purchased, and we can come in on the front end. So, there's certainly opportunities to inject capital. That's one of the things that the fund could do. But I would say even more predominantly, we're going to continue to be focused on deals that are transacting. We see a lot of loan assumptions happening in the marketplace where, these excellent rates that still have some term left. We're seeing operators sell those because it's very attractive for a buyer to step in, as long as they can assume that loan's very attractive. So we're seeing a lot of those loan assumptions. And then the unique thing with the loan assumption is that although you get a lower interest rate, you also have a lower loan to value. And so generally operators are either having to raise all of that through common equity, or they can come to somebody like us where we can give them kind of somewhere in between, where this is not necessarily cheap bank money, but ultimately our returns are capped, and so they can kind of pass through a lot of that, a lot of that back end equity to their investors and maintain kind of some higher returns for their investors. So we're seeing a lot of that these days, and I think we'll continue to see that.
Yeah. Yeah, thank you, Mike. Absolutely. So we're going to talk about those a little bit more because we're going to give you like specific details, what type of deals we actually funding today. So, but then I want to go back to the slide, right? High yield. What does that mean? It means like a double-digit return with a preferred position in capital stack. So the first two things I want to talk about, right? Because again, you're talking about syndications back in 20s, 21, 22, 23. A lot of you guys, and if you've been active, right, and investing into the deals, you probably experience capital calls. And the reason why you actually experience those, because you're at the highest risk on top of the capital stack, which is just the equity position, right, which is at risk the most. You do get the best return. I mean, you probably get about 15-20% return, but right on exchange to that, you inherit all of that risk into the deal. And this is what's happening right now, or maybe like a couple of years ago as well. So, and preferred position capital stack, meaning so you got a priority of payment right before the common equity holders, and which is a huge part on today's market. We're talking about why it's today, right? So on today's market, it's huge, right? Because you secure yourself in a better capital stack position. So, and next one, it's an open-ended structure, which is, again, it's a flexibility in my opinion, right? So you don't get diluted by new capital contributions who's coming in, right? So it's always at net asset value. So maybe a little more technical. So we're not going to go too deep into that. But again, so you don't get diluted, meaning so every time you're coming into the fund, let's say you put $50,000 today, you put $100,000 a couple months after, right? So you still get into that preferred position. So you don't get dilution rate of your capital in that thing. So, and then the 2-year lockup period. So we're talking about, again, 2 years, which is 24 months, but you can actually say at the months of 21, right? And basically less than 24 months, right? You can say, listen, I want to get my capital back, right? And this is an option as well. So I think with a regular syndication deal, you probably get into the deal 3 to 5 years at least, right? 3, 5, most likely. In this, right, in that structure, right, you can get out in 21 months. You can say, listen, I want to get out in 24 months. You get money back. Okay, strong sponsor team. That's big time, right? So because Aspen Fund's been doing this for a long time, so it's 11 plus years of track record, and that's our partner for the credit fund. And then, maybe Mike, you can dig a little bit deeper into specific role of I forget his name, right? The guy you guys actually using for that specific private credit fund structure.
Who on our team is running point for that?
Yes.
So our chief investment officer, Ben Frazier, that's really who guides really all the allocations for us. Terrence Wise would be our senior analyst. Terrence really runs point on kind of the day-to-day, the underwriting, the asset management. He oversees that. And then we have a loan committee. So that loan committee is made up of our 4 partners. So Bob Frazier, Jim Mafuccio, Dan Schulte, and Ben Frazier. So got a lot of experience. I mean, over 100 years of experience in real estate and debt across those 4 partners. We'll be adding some third parties to our loan committee. So Anton Matley being one of those that we're engaging with. So we'll see how all that kind of shakes out over the next year. But yeah, that's the basic structure.
Yeah. Thank you, Mike. And then last couple of points, it's element of we co-investing right into the fund because we believe in the project as well. And lastly, it's diversification because, again, we talk a lot about the hard money loans because, again, when you talk to people saying, listen, we got a private credit fund, but they start to compare this to the hard money loans. And a lot of times your capital was hard money loan tied up to the one specific property. And God forbid if this property is not performing, so you are exposed to to pretty large risk, right? Because why? Because it's just the one thing, right? And then in the inside of the fund, there's a multiple different, not even that, it's just multiple different structures because it's a mezz loan, right? Could be like a pref equity financing, right? And breach loan, let's say, and all of those 3 are different. And sometimes it's a different asset class, not sometimes, always, right?
Yeah.
Different asset classes as well, right? There's industrial deals, there's a multifamily deals, and there's a land play as well, right? Land deals. So all of those are different. It's like diversification of not just location, management risk, and it's also the asset class as well, right? Which is, in my opinion, one of the most important things when you're talking about the risk, right?
100%.
Yeah. So, okay. Let's move on to the next slide. And we got the performance. I think this is the probably the most important and then very interesting slide for me. Deployment of capital. I think I'm going to give you, Mike, the words for that because you're going to flow through that a lot better. Can you go over and then give us, because those are just the recent, I think we just got those numbers like last week or a couple of weeks ago, right?
Mm-hmm. Yeah, this would have been as of Q3. So you'll see 9/30/24. We've got more activity that's happened since, but for sake of a closed quarter, we've got 95% of the capital deployed, meaning we're being very efficient with capital that's coming in. So that's reducing, cash drag, which ultimately can reduce returns for investors. So it's very, very important to maintain very high level of deployment, and we've been very successful with that. So as of Q3, we had placed capital into 6 investments. Again, we've got another already under a term sheet, signed term sheet, and getting ready to close here in the month of December. So that would bring us to 7. We've already got 8 and 9 kind of staked. So this is just consistently going to grow. And again, these are kind of $1 to $5 million check sizes. As far as gross yield, so this would be at the fund level. So just shy of 18% gross yield. So what that means is, between all the accrued interest, the actual current interest that's being paid at the asset level, fees, et cetera, that creates a gross yield. And so all of that is what creates kind of that top line, revenue for the fund, if you will. And then, kind of expenses can come out of that. So really, really strong yield being in a debt position. So average length of term, 2.15 years. This is important because we have a 2-year lockup. So maintaining that kind of target on average is being, paid off in that. That's what's creating the liquidity for us to be able to provide liquidity for investors who would need to exit the fund for any reason. But again, this fund is designed as an open-ended fund. So our intention is to operate this far into the future. So 4 states, got some diversification in geography. So loan metrics, this would be kind of underlying assets when you look at all of those across the board. So loan to cost, 71%. That means we got on actual cost, we're at 29% equity cover, which means if, for some reason there's default, we could sell this even theoretically at a discount and still cover our interest. So very, very important metric right there to be kind of in that 75% and below. Loan to value as stabilized. So as a lot of these projects are adding some type of value. So as those get stabilized, the values are increasing. So that number obviously being even a bit lower. So that's combined. That means senior position. If we're in a second position, some of our positions are also senior. So it includes kind of all of those loan positions as a combined valuation. So due diligence, 100 million in deal flow reviewed. We're at less than 10% approval, which just kind of tells you that we're being very picky and choosy as to what deals that we're doing that fit right with the portfolio, kind of balance risk cost across geography, asset class, strategy, loan type, et cetera. That there's a lot of diversification there. So we do a lot of work, a lot of legwork to ultimately cherry pick and find the best deals that protect our fund. So all investments are current. They're progressing according to their business plans. So far so good, and no end in sight there.
Thank you, Mike. So, and I want to just double down on a couple of things. Deployment, 95%, like you said, it's very, very important. Why? Because the cash drag, meaning so you get the funds and you already kind of need to pay out the dividends, right, to investors, but you actually didn't deploy them. That's what creates the cash drag, right? And that's very important. Sure. So it's going to be on a timely manner. So meaning you need to source the deal and you need to get the capital kind of in the same time, right? And then, put them together, right? So, and number of investment, we talked about the risk before. So, and this is one of the good metrics as well. There's 6 different deals right now. And the question I'm asking myself always, right? So what are the chances all 6 are going to fail, right? And that's a very, what's the probability of that happening? Speaking of the math, right, language. So, and it's very, very low, right? It might be one of them, let's say, right? But maybe like 2 of them, but what are the chances of 6 of them will go? So this is the type of things when we talk about diversification and risk. This is the importance of putting your money into something which is diversified between different things. And we're going to go to the next slide right now. And before we go into the next slide, I want to talk about the current yield. Investors right now at the moment get like 11% as a current yield. Yeah, it's a little over. I always say less than more. So to people, and again, they get a little over, so it's like close to 12 actually. But again, 11% yield on really, I would say, again, we're not senior position at that, right? We are secondary, but anyways, it's very, very secure placement in the capital stack, and you get double digit return paid monthly. That's huge. That's a big time, right? It's not paid after 3 years. I want to say it one more time. It's paid monthly, right? And then it's catching up quarterly, and it's about, I would say, maybe prove me if I'm wrong, it's about 6%, right, Mike? About monthly, or 6-7% plus
Yep.
a catch-up payment every quarter. And the reason why, because some deals are just originating, right? The feels coming in, and it takes time to reconcile all those things. And then quarterly, you're going to get the catch-up payment as well. So it's going to get blended into 11%. So, and now what we want to talk about, we want to talk about specific deals and the cases inside of the fund. And we discussed that multiple times. It's very hard to people to digest what the fund looks like. But then when they see the real life example, like, oh, I get it now, right? Oh, I understand how that works. Because again, it's overwhelming to really understand that without specific details into the deal. So, and we want to start with number one, right? There's 6 deals, like we said before. The first one was a loan assumption multifamily deal, Lee Summit, you know, in Kansas, I think, right? In Missouri. And then we got
Missouri. Yep.
Missouri, sorry. Yeah. And then we got the second one, preferred equity. This was an industrial play, really good deal as well. And it was in Georgia. And then we got pref equity multifamily takeover deal. So it was number 3. The reason we don't talk about it in details, we already discussed that multiple times. And we want to talk about number 4, number 5, number 6. And can we start with number 4? Mike,
Yeah,
can you
please.
give us a little bit of details, like really details about why would they do that type of deal, right? Why would they not go to the bank in this specific example of number 4?
Yeah. So this is a excellent market. This is Bentonville, Arkansas. This is kind of one of the best kept secrets that's kind of no longer a secret as one of the best, fastest growing markets in the country. We have some equity investments already in this market that have done quite well. This is a particular developer who is a family, multiple generations of family members who have been very successful at multifamily development, among other asset classes in this marketplace. So, one, the sponsor themselves has an impeccable track record, and basically self delivers on all of their own developments. So, fantastic operator. This market in particular is basically top. Gosh, I mean, it's got to be top 5 fastest growing markets in the country. So you've got some key things happening in this market. Walmart is headquartered there. Walmart has really driven massive economic growth in this market. And kind of what's behind that is they actually require their vendor relationships to have physical offices in Bentonville. And so it's stimulated a ton of relocation actually from the coast. So we've got lots of California, lots of East Coast just pouring into Northwest Arkansas, which Bentonville is kind of the central hub, or not. It's not central, but it's kind of the largest, kind of wealthiest area of Northwest Arkansas. So we love this market. This is a very straightforward play here. Is they're building more multifamily. They need more inventory. They don't have enough inventory. This was never a major market initially, but we're seeing kind of Austin-esque type of growth in this market, and so yeah, the underlying economics here are fantastic. And what they needed is some more working capital for their construction. So they're getting started on. They've kind of finished entitlements. They needed some pref equity to kind of close on the land and get started on construction. And so this is about a 2-year timeline where we're going to get refied out of that, like that final construction loan that they'll secure here in a couple of years. We'll get refinanced out at that time, and or potential sale. So they're basically preparing the property for kind of large scale development. And so it ends up being kind of a short term deal for us. The reason they came to us is we kind of have flexibility in terms. With development, cash is very, very important. And so we're able to create a structure where they're getting 6%. They're paying us 6% on kind of annualized, but paid as a monthly mortgage. But we're also accruing 10% that compounds annually. So all of that 10% just kind of continues to grow. We're getting some fees, obviously, and then we also negotiated 0.5% of kind of an equity kicker at the sale. So this is going to be a really nice yield for the fund. This is this is 19-20% type of yield for this asset. So
Thank you.
all this kind of boils down to it checks our boxes.
Yeah.
It's that kind of 2-year term, seasoned operator, really great asset. We have takeover rights as well as forced sale rights if there's non-performance. This is a relationship that we already have, so we have a lot of confidence in their ability to do that. So
Yeah. And
it
combined
checks
LTV
box.
pretty low as well.
Yeah, I got a huge equity cover.
I just want to double down on a couple of things. One is you guys learned a new market, which is incredible, right? Arkansas, Bentonville. So, and again, so you want to get when it's quiet. Like you don't want to get into the market when everybody, oh, you know what, let's go in Austin, right? Texas and blah, blah. So I would, again, that's my personal, I might be wrong, but I would personally project the next 10 years and that market is going to be really well played, really well played. The reason why, because you just start to hear about that just popped up, right, to the public. So, and a lot of money to be made there. That's one. The second one is um, the 66% LTV, loan to cost, not LTV, LTC, right? Loan to cost. So Mike mentioned one thing that's very important for them to get the funding, right? To get the construction going. But timing, so it's even more important, timing for construction. So because they didn't, just imagine they got a land. So they did all the entitlements, right? And now every single day of delay will cost them money, right? If they go to the regular finance, if they go to the bank, it's going to take them how many, like 6 months maybe, right, to get the financing. And then when they come, sorry guys, when they come to the private equity markets, right, it's like almost, I mean, compared to the regular market, it's almost instant. They get the money within like 60 days or so. And that's huge because when you do in development, the timing is probably the biggest issue, not even the capital, the timing of that capital received and start to build, and then all the teams in place and stuff like that. And lastly, so how many deals, I'm talking about interest rate section, right? How many people are actually willing to share the sales price, 0.5% of that? You don't get those type of things, right? And if the deal is doing well, I mean, if you got seasoned operator, I'm talking about the risks here, right? So we talking about the development, and development, the biggest risk of development never gets developed, right? But now you talk a track record of the operator, right? And they've been in existence multiple times. They did it multiple times. So you say, okay, that's checkbox, right? And then next thing you see, like, okay, they're willing to, again, to even give you 0.5% on the back end. And you know it's a growing area and a growing market. And it's not for 1 year, for 2 years. It's going to be for the next decade, right? Because the Walmart is a huge company who's getting bigger, right? And getting stronger, right? And that's going to be, you're going to get on that wave of development of Walmart and all the area, right, together. So that's a huge deal. That's a great deal, I think. And the next one, Mike, if we can go into the next one, which is kind of, I would say it's a neighborhood retail center, right? It's not, again, those are like a smaller, I just want to say one thing. So how many people on institutional level will be willing to fund $400,000, right?
None.
Like you got to go to the probably neighbor and say, listen, can you give me a loan
Right.
$1,000? Yeah, this is what I'm talking about. So you have a flexibility inside of the fund, because again, if you go to institutional players and you say fund $400,000, they're not even going to talk to you, right? Because they'll say, what is that, like $400,000? We're not going to look at the paperwork for that number, right? So, and this is the flexibility, and this is what we actually doing, right, on the market. So we're providing the capital for the smaller, right, amounts, again, which is a huge, I think, market in general right now. Yeah, can you go over a little bit like more mass debt, right, the number 5?
Mm-hmm.
Retail.
Yeah, so this is a mezzanine. It's mezzanine debt, meaning slightly different. So preferred equity is technically equity. Mezzanine debt is debt. So functionally, they're very similar, but this is has a lien on the entity that operates and owns the asset. So just kind of different types of controls, basically. But we really love this asset class. It's very fragmented. Honestly, we probably wouldn't, we wouldn't do a whole lot of deals like this, except for because, to kind of your point, it's the size is not large, but the inverse of that is it's a great asset that isn't going to cost us a whole lot to get some fantastic returns with an operator that we already have. We've got history with. We understand how they operate, et cetera. So these are just steady Eddie assets. I mean, unique thing about neighborhood retail is they haven't been building them for since the 80s, really, probably is the latest. So, I mean, there's really no inventory here, and they do very, very well. Occupancy stays high. You've got your nail salons, you got your insurance office, you got your local restaurants and things. You got your dog washer, um, hair salon, barbershop, and they tend to stay just steady Eddie, nice and full. So this is nothing, nothing sexy, but
So
it's
small
but
essential businesses, right? Like those are like a neighbor, small
essential businesses.
essential. Like where are you going to get a haircut? You're going to travel like 50 miles to get a haircut? No way.
Exactly. And you're not going to go to some big box retail. You
Yeah.
know, this is kind of the bread and butter where people live, and we see it all around us. So everyone's experiencing this, and we see actually a lot of a lot of local economy just continuing to keep these small businesses going, and the occupancies ultimately stayed quite high. So this is just a very simple value add strategy. They also need a little bit of gap funding. They raised what they could raise. They needed $400,000 to complete their raise. They're doing very light value add slash lease conversions. You know, a lot of these are mom and pop type of own. So when they're buying this, they haven't been professionally managed. So those leases need to be converted to triple net leases, and so a lot of the value can be driven through that. So we've done this on the equity side. We have a retail portfolio similar to this that we own and operate, and so we know the asset quite well. We know these operators quite well. This is kind of right in our backyard. This is Derby, Kansas. This is just kind of south, a few hours south of Kansas City. So it's simple, easy one with a lot of cash flow. That's the nice thing about these is they're full, so they got a lot of cash flow. So the debt service is not an issue.
Yeah, and the good thing again, so you need to be present to really understand it's going to work well, right? Why? Because you got a sense of that community, right? Of that retail neighborhood center, right? Because again,
Yep.
I'm driving some streets, and this is my personal. I'm driving some streets. Oh my God, I was like, that's a great like corner retail center. And the reason why, because there's nothing within the miles in between, right? Like there's nowhere to
Yeah.
go, and the business will be there forever. Why? Because there's no way for the big retail things to come in. Why? There's not enough people to serve, right? But then for the smaller retail center, right, there's no reason it's going to be under occupied. Why? Because again, people need the services locally, right? And they willing to just again be there, right? And then you need to get a feel for that. You need to be present there. So and that's why it's
Yep.
in Kansas, right?
Yep. You got it.
Okay, so Mike, I think we're not going to go on the example number 3 because we're like a big talkers, and it's been like a 30 minutes so far, and what I wanted just to say a last slide before the last, I mean, last slide before the last one. So looking forward to Q4 2024, again, risk adjusted opportunities, particular mezzanine financing deals. And the reason why, because it's a debt financing, right? Is that true, Mike? That's why we're looking
That's
into
correct.
it, because it's like even more secure than pref equity in those positions in this capital stack. A lot of questions I get, look, there's a interest rate going down, right? And they probably can refinance and finance for a cheaper price. The answer is no, right? There's nothing. I mean, listen, the interest rate did get a little cut, right? But really the market is still the same. I don't know why. Maybe you can comment that, Mike. So I don't see money getting cheaper, right? And then we maintain strong pricing, meaning so we just give the capital right to the people who needs the capital at the same price, like the same charging, the same fees, same interest, right? Nothing changed was a recent rate change. Let's see what's going to hold the future, what the future holds for us. But again, so for now, market is stable and still the same. There's a lot of capital on the market, and again, there's a lot of need for capital because deals are start to move finally. So we start to see the shakeout right on the market when the deal starts to pop up. There's interest in the sellers are willing to go down on the pricing, right? And the real estate start to change the hands a little bit more and stuff like that. Can you just comment on that, Mike? So what do you think about the pricing and what's going to happen in the future if the interest rate will go down more and more, if it will?
Yeah. I mean, I kind of alluded to it earlier. I mean, nobody for sure has a crystal ball, but it's actually kind of interesting for those that were kind of watching. The bond market is kind of a leading metric to see, to be an indicator of what interest rates will do. So it was kind of interesting because we saw rate cuts in September, and then we saw bond rates go up in October. So, there's a few reasons for that. That's an oversimplification, but I think the sentiment from our end is that we're kind of two things. Is we're going to see inflation being pretty sticky for a number of reasons. One, I think there's a lot of cash out there. Consumers have a lot of cash and savings still, and when consumers have cash, they generally spend it. And when buying power is like that, demand is remaining somewhat high for consumer goods, which will keep inflation stickier. So, obviously some of the levers that the Fed can pull is going to be interest rates, right? So how do we mitigate and continue to reduce and control inflation? So I think from where we stand is we're not expecting anything significant in 2025. I think as we look ahead, I think 25 is a very important year, and I think it will give us some insights on the forward outlook. But I think 2025, we're not going to see significant change in terms of rates. So there's arguments that we could see those go up potentially. It's a big unknown. I think we're in some unprecedented times, compared to past cycles. So it'll be interesting to see how it goes. But from where we stand, I think to your point, I think properties are being sold at some discounts. So I think there's going to be some great deals happening. I think credit with banks is going to remain tight. I think banks are, very cautious in an environment where there could be, recession at play as kind of an unknown. So we'll be monitoring that carefully. But all in all, we see this as a great way for us to go lower in the capital stack, reduce our risk while still getting into some of these great assets. The underlying assets are in great shape. A lot of the issues that have been prevalent are really a basis issue. Somebody overpaid, and then interest rates going up affects valuations, and they haven't been able, to your point earlier, been able to refi out of those. So some corrections are being made in these asset classes. So those that are positioned to transact and go take down deals, we're planning to be there and kind of do so in a little bit, with a little more mitigated risk.
Absolutely, yeah. Thank you, Mike. Thank you very much. It's super insightful. Though for the last portion of that slide, it's market position. Again, it's a high pricing power. Look, meaning, so again, the money are still the same priced, and we're still able to get a really high interest rate on loans, right, under $5 million. And the reason why, because there's not a lot of competition, right? There's not a lot of competition who want to touch that market, right? And we kind of found a sweet spot right on the market, and we just double down on that sweet spot. So, and we just continue strong risk-adjusted returns despite lower rates as well. So that's the market sentiment right now. That's what we're doing right now. So the last slide, and we want to finish here, right? We're going over 30 minutes. And we actually always have in mind to keep it under 30. So if you do guys have any questions, right, please let us know, right? You can send us email at invest@avistafund.com. Also, we do have some incentive for you, right? If you just contribute capital by December 15, right? By the half of the month. So we got some exciting incentive for you guys to let us know if you want to move forward. And Mike, thank you very much for coming up, right? It's always insightful, always incredible to learn more, right? And learn some more markets, expand your vision and mind. Thank you for coming, Mike.
Love it. Appreciate you, Igor, as always. And we'll look forward to next time.
Yes, you guys enjoy your day, right? Everybody have a great time. Thank you. Bye-bye. Disconnecting.